Hello, and welcome back. Um, let's see. This is a continuation of enterprise structure. This next video, this next slide in this particular section is regarding business units. Obviously, a very important part. So, managing multiple business units require that you segregate them by strategic objective and measure their results. Obviously, this is very important thing to divide departments into divisions, subdivisions, so the particular managers can give accurate results as to what they've been doing. So again, we divide business units. You can divide them, or you can kind of manipulate them by having divisions and subdivisions, lines of business, other particular strategic business units, and you want them to have their own revenue and cost centers, obviously, since you want them to be independent and accountable. Um, again, we that's the purpose of an ERP, is to have, one of the purposes is to have good reporting. Let me go to the next slide. So defining a management reporting structure. Few things I want to mention about this slide. You have two divisions here. Air Systems, for Infusion America, you have Air Systems, and you have a Financial Services division. This, by definition, you obviously know that the Financial Services division is different, very different business processes. It's financials, it's financing, as opposed to basically, it sounds like goods and services that are coming out of the Infusion Air Systems division. This particular air system is air quality monitoring. And this is, again, strictly a financial. So let me go to subdivision. The air system division, you have two subdivisions, system components subdivision and installation subdivision. And again, this is divided for obvious reasons. This is the components, the nuts and bolts of the particular air systems. And this is the installation service, man hours. So obviously two different beasts. I'm thinking more than likely this is going to be, you're going to have projects involved with this, because installation might end over a long period of time, and therefore it'd be more suitable for a project. So just in summary, and these are the individual business units. It goes down further to air compressor, air transmission. Your two different services, electrical services and mechanical services, obviously require men and man hours. So in summary, use business units for management reporting, transaction processing, transactional data security. In other words, you don't want somebody from this unit seeing something that this other person from this unit is doing, vice versa. The data is, there's a brick wall in between those, a firewall. One can't see the other for obvious purposes. You don't want people dabbling into other managers area of responsibility. And finally, you can share reference data across all four of these, payment terms, things such as that. That's a functionality that Oracle has. And my thought is that this type of structure should be applicable to any particular, particularly high-end ERP, because that's what they're built for, to deal with international organizations and multiple divisions, subdivisions, business units. So at this point, I'm drilling down. You can see the individual business units. So perhaps each of these you'd want to have a manager for each of these who answers for profit and loss. And another idea here is you can have a cost center. You can designate an account in the accounting flex field as a cost center. Let me go over one by one as far as business units. What's included, at least with Oracle on business units? What functionality is available? Now, if there's a dollar sign, let me go to the first. You can see there's a dollar sign here. If you see a dollar sign here, that means that it will need a primary ledger. You're going to have to assign this particular function to primary ledger. Basically, what I'm going to go through is every functionality that a business unit has. And you will see as I go through these, it's just basically just the activity of business, of the business, particularly, related to the financials. So billing and revenue management, that's part of the functionality within a business unit. Collections management, again, as the dollar signs here indicate that you're going to have to assign this particular functionality to a primary ledger and a default legal entity. Customer contract management, customer payments, expense management, incentive comp, marketing, materials management, order fulfillment orchestration, payables invoicing, payables payments, procurement contract management, project accounting, receiving, requisitioning, sales. Just several. Obviously, just a huge amount of functionality in the business units. So business unit is obviously very powerful. Not much general ledger stuff, not much asset stuff, but accounts payable, accounts receivable, cash management. Yeah, all that stuff. Collections management, all that important stuff. Project accounting. So a lot of functionality there. Regarding business units and product projects, you can see in this graphic here, there's one business unit, and you have two project units related. One is sales and consulting. The other one is IT services. Obviously, in both of these, you can see it has to be, the business is done in kind of a project format. In other words, for sales, it's kind of a project that months at a time, as well as consulting. You have a team of 10, they're on site for so long, they're billing weekly, they requisition things, so it has to be in a project. And another one's IT services. Again, that needs to be, at least in this particular instance, it is represented as a project unit, and I'm assuming it's appropriate. I'm not sure what the Oracle people had in mind, but so a project unit is basically an operational subset of a business enterprise that conducts business operations using projects. It enforces consistent project planning, management, and analysis reporting. As far as what the services are here, usually it's consulting, as it is here, sales, and research and development, things that last over a long period of time. You implement the Oracle project portfolio management, you are required to set up at least one business unit. So if you're going to use the projects, you're going to have to set up one business unit. We move on to the next slide. Business units and projects. Business units have several business functions. I mentioned all of them later, but you can see that, for instance, project accounting, billing and revenue management, and payables invoices is relevant for this one. And notice how this is positioned. There's one research and development project team, but what they do is they're responsible for the UK business unit as well as the American business unit. So all the R&D encompassed in one project. Obviously, dividing it up in between these two would make it more difficult. Here, you could just roll it all into one, and they would get the benefits of the project. So, financial reporting structures. This is important. You want to represent your enterprise structure in your chart of accounts. You want to be able to track reports on financial objectives, and you want to meet your reporting requirements. I want to mention that I'm not going to get too deep into it with this, but you got multi-dimensional reporting with the Essbase Cube. That's another thing you have to buy, but it's a good product. You can, I guess, when you're setting up, but this is for an Oracle setup. When you're setting up Oracle, you want to keep, particularly this general ledger, you want to keep Essbase Cube in mind. There'd be a real-time transfer from Oracle files. At this point, I'm not going to get too deep into it. I just want to focus on enterprise structure, but perhaps in other presentations I'll do that. And this is a very important thing, a chart of accounts workshop. This, if you're implementing an ERP, or if you're implementing a new ERP and you haven't touched yours in a while, things get way out of whack. So these are 5 questions you should ask. Again, if you want this slide, Joe, feel free to email me and I'll send it to you. But I'm not going to spend a lot of time on the questions. So we're going to dig deeper into chart of accounts here in the next few slides. Chart of account challenges. I would like to go over these things. For instance, perhaps I don't think people spend enough time on this as they develop these things. I know, having supported Oracle for a while, I'll get a lot of calls from the financial analysts asking about how to pull this report and that report. Well, a lot of these issues can be solved up front by making a proper chart of accounts, or using other business intelligence products. But let's go one by one. Business units within the company have different chart of accounts and different reporting priorities. This is a case maybe where you have bought businesses that didn't exist, and you really didn't plan it, and now you have different chart of accounts. Perhaps you merge them into one. Perhaps this particular implementation or re-implementation would be a good time to think about that. Reports don't produce the information the organization needs to properly run the business or meet tax and or regulatory needs. Again, the chart of accounts is, at least for Oracle, EBS, and cloud, it's really hard to repair once you've established it. So please keep that in mind. General ledger accounts aren't used consistently across the organization, reducing the effectiveness of reporting and consolidation. Again, the workshops might be a good time to get feedback across the organization to kind of make sure this problem doesn't exist. The chart of accounts has not kept up to date with changes in the business models and the statutory and regulatory environment. Very common problem. There's a lack of flexibility to integrate mergers and acquisitions. Yeah, that's a common problem. It's often consulting companies are called in to take care of this, and it gets expensive. It's not clear who owns the chart of accounts or has the responsibility for maintaining it. True, happens a lot, and it's a lot of money to implement these ERPs, and then people just drop it and forget about it, and then the responsibility just kind of goes by the wayside. People go on about their business, and things get confusing. But it's a good time to just take stock of these things. The chart of account has limited scalability to support changing business models and organization restructures. Something to think about in your workshops. Chart of account processes and policies are poorly defined. Very true. There's a limited use of subledger systems for low-level analysis. There's no link between key performance indicators and the chart of accounts. There's a lack of training on the chart of accounts and poor management of chart of accounts. Change it. That's common problems I hear a lot. Chart of account challenges. These are a few things that are happening. There's trends where a CFO must give a lot more analysis to the board when there is economic uncertainty. Obviously, yeah, when corporations are in trouble, information is very, very valuable. And, again, it's expensive implementing these things. So, you don't have, you want to get those IT people out of there. So, you can get your work done. But when it's things are stressful, they want to get that information. So there's a lot more answering questions from external auditors and regulatory bodies. Everybody wants to have a deeper understanding of debt and financing issues. So that's something to think about when you're doing your chart of accounts, designing it. And finally, more frequent informal interaction with the audit committee. You're going to want that they want the information they want, and I hate dealing with those audit committees, but it's a necessary evil. They ask for strange reports. Anyway. Regarding designing your chart of accounts, purpose. Let's see. Let me go over a few more things about the chart of accounts. Designing your chart of accounts. The chart of account structure provides a general outline of the chart of accounts and determines the number of segments, the type, length, and the label qualifier of each segment. 90% of business owners can probably relate to never having looked at their chart of accounts. Even many controllers and CFOs are weak on how to structure a robust chart of accounts that easily and plainly produces the financial information management wants to see. Accounting teams tend to focus on doing things the right way rather than asking the readers of the financial statements what they want to see. A successful chart of accounts, there's only one type of information in each segment and one segment for each type of information. Let me go over this screenshot here. Again, when you're designing your chart of accounts, a lot of times you only think of financial accounting and not as much managerial accounting. But it would be helpful to your business in general to have this perspective. The purpose of managerial accounting, obviously, is decision making for upper level, lower level managers, CEOs. And financial accounting is communicate financial positions to outsiders. Again, both important goals, but the thought is that this is somewhat ignored, and you want to take this more into consideration. The primary users for managerial accounting is going to be internal managers, and financial accounting is users, people who want to buy, sell the stock, or board of directors, those type. So, yeah, again, the thought here is that these people are somewhat ignored in many cases as opposed to the external users. The focus and emphasis for managerial accounting is future-oriented, whereas financial accounting, obviously you're reporting on past results, profit and loss. So that is a big difference. As far as the rules of managerial accounting, you don't worry about GAAP. Cost versus benefit is more what you're concerned about. In the financial accounting, it's GAAP compliant CPA rules. And again, these two goals, they're different, and you want to be able to facilitate things so that both of these people, financial and manager, get what they want. Time span. This is a very long time horizons. When you're thinking about making a product, obviously, you want income for years and years in the future. And you want to design a system that takes that in consideration. Whereas here, financial accounting, historical monthly and quarterly reports, more of a historical view. Behavioral issues, this obviously is designed to influence employee behavior. Management wants, they'll be able to see, if some people, some production lines aren't producing properly, and it'll reveal that to them if it's set up properly. Here it has much less indirect effect on employee behavior, although you do want to have good financials or you might have layoffs. As far as designing a general ledger, a chart of accounts, there's thick versus thin. You can see here the thin GL is very short. In this case, it has an org, a department, and an account. And the thick is much longer, much more detailed. You have a customer, vendor, project, location in this field, whatever that stands for. In some cases, at least with Oracle, you could have a primary and secondary ledger. So you could have one thick ledger and one thin ledger. In other words, I think I mentioned this before, you can possibly have two ledgers. One, perhaps you do your daily business in and it's thick and it has all of these fields in it. And then you can have that export real time to a secondary ledger, and you could see the reports on a thin GL. Just an option for Oracle Cloud. For a thin general ledger, retail is often thin. The reason for that is, of course, the GL tracks overall sales numbers by region. But the point of sale system that usually is companies, retail, just has excellent reports. So you don't need the thickness here. It's the point of sale system tracks sales and inventory by store, product, supplier, and markups. You get a very nice picture without that information. And generally people think the thin GL is preferable. Right with it. No, if you want that granular, information, and you don't have a good business intelligence system, I think it's probably appropriate. Something to consider in these workshops. Anyway. A thin GL can be used in conjunction with the enterprise profitability management product, which has data standardized from each operation. So again, as a thin will have a minimal chart of accounts, very short list of costs, short list of natural accounts. It'll have a low number of optional segments, and it'll have an infrequent posting. If you, for instance, in your implementation, if you use Oracle projects, it's probably best to go ahead and go with thin GL, because what you'll in the project portfolio, the Oracle project portfolio will have excellent business intelligence, very good reports. So the thick is not necessary in that case. A thick general ledger is used as a detailed analytical tool performing analytical functions in the general ledger. It has segments representing all aspects, captures every detail of your business. It finds many values. There's probably going to be many values in each segment. So setting up of the chart of accounts, a lot of entering in values. An example of a thick general ledger is an electronics manufacturer. So they have detail on the revenue line. It's tagged by sales channel. The product is structured differently to provide detail on cost of goods sold line, including your bill of material costs. And the GL is used to compare and contrast revenue and cost of goods sold for margin analysis. Thick characteristics, maximum use of chart of accounts, long list of natural accounts, long list of cost centers. You should really think about thick. I guess thin would be preferred generally. Smaller, less complicated, but think about thick if you track enhanced currency balance. If you track entered currency balances at the level of operational dimension or segment of your chart of accounts, such as by department or by cost. You generate financial allocations at the level of operation dimensions or segment. If you report using multiple layered versions of hierarchy of the operation dimension or segment from your GL. Thick versus thin GL consideration. Let me go over these one by one. As you're considering whether you're going to do a thick or a thin GL, if you have an EPM system and its capabilities, you're probably good with a thinner one. If you have a good business intelligence system and you have all its capabilities, you tend to want a thinner chart of accounts. If your sub-ledger systems and their capabilities and characteristics include heterogeneity, general ledger reporting systems and their capabilities, you have to consider that when you're thinking thick versus thin. Now, if you have a good GL reporting, you can go thinner. That's something you want to talk to your implementation people about. Maintenance required for the thick or thin distributions and record keeping. Yeah, you got to think about that. If there's going to be a lot of manipulating of the value sets, what we call, value sets are just the variables you can have for each segment. Be a lot of that. Maybe it's you want to get a good business intelligence system, and you want to go to more of a thinner ledger. There's maintenance required to update value sets for the chart of account segments. It's another thing you want to consider. Preferences of the product that serves as a source of the truth. Of course, the level at which to report profitability, including gross margin analysis, and the industry and business complexity. I do want to concentrate on two particular segments. First one is cost center. The second one is departments. Regarding cost center, there's the national account, which represents assets, owner equity, and all the other balance sheet entities of an expense. And then there's the cost center represents the destination. It can represent the destination, which is Alabama or the Northeast Territory, for example. Or it could represent the function, maintenance, customer service. So that's something you want cost center. That's how you want to design cost center. As far as departments go, an organization with one or more operational objectives or responsibilities that exist independent of its manager. So Department is an entity in itself, and it usually has a manager to it that represents it. So the manager is separate from that department, but you need a manager to run a department. So a department manager is going to be responsible for cost control within their department, track assets using their departments, manage employees, their assignments and compensation, and finally, somebody like the sales department might be responsible for revenue targets. Here you go. For instance, the sales team for this could be a department. As far as putting together a cost center and department, the relationship might be unrelated. They might be identical. And they make it such cost centers tracking the costs of one department. So just a few ideas regarding those two particular segments. Neither the departments, neither the cost center nor the departments is required, but it's a very integral part, particularly if you have a thicker general ledger. Departments and project-based business. Classify departments as a project owning organization to enable associating them with projects or tasks. Project association is a key driver for project assets. Classify departments as project expenditure organizations to enable associating them to project expenditure items. Now there's 3 departments I kind of want to review here. This is when your department is a sale and marketing org. I just want to show how this works. You got your air compressors business unit, and you have a sales department. And your department is divided into two sections, of east and a west. You can see here, let's just pretend this is your manager. So he's going to be managing and will have final responsibility, profit and loss for this whole sales department. You can see he has 2 cost centers underneath him. So perhaps there's another manager here, or he can break down and make sure everybody's producing properly. So he can give proper reportings to his CEO or his higher ups, but this is kind of the purpose of the department and the cost. This is how it would look if it's kind of the sales and marketing part. And the second one is it's a cost, instead of sales and marketing, cost. So you can use a cost organization to represent a single physical inventory facility or group of inventory storage centers. Cost org can roll up to a manager responsibility for the cost center in the financial reports. And at this point, I'm going to stop the video and thank you for listening. And I will make another video here soon. Again, if you have any questions or if you'd like this slideshow, feel free to email me and I'll forward it to you.